All right, so I looked up last night after the market closed. I looked up Ford stock, right? And so I decided to make a little comparison of selling naked. By the way, that's also called selling cash secured puts, which everybody keeps asking me about. In fact, I even had a gentleman call me the other day, and he kind of was like, hey, I'm interested in being part of your program. I'm like, good. He's like, but what about selling cash secured puts? And I was almost like, ugh, it's almost like somebody takes the air right out of my sails. I'm like, what about it? And he's like, well, da 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 da. And then he started to argue with me that this was the best strategy in the world. And I said, well, it's the same thing as writing a covered call. And he's like, no, it's selling cash secured puts. So if you don't mind, I'm going to run through a little scenario. So let's talk about selling a cash secured or naked put. So if I was to sell the Ford June 16th, so this is going to expire next month, $11 put, based on the closing prices yesterday, I'd make 20 cents per option share sold, right? So great. Then the next piece of that puzzle is as soon as I sell that put, my broker is going to make sure by doing a margin requirement or margin call on me, make sure that I have $11 for every option share I sold because that's the obligation I just took on. I basically said I'm willing to pay $11 for a share of Ford if somebody exercises that. So my broker immediately locks up $11 for every option share I sold. That's part of selling a naked put. So in effect, I've got kind of a break-even price of $10.80. My broker locked up $11 per share in my account that I can't spend now because they want to make sure I have that. If I do spend it, they're going to start sending me really evil emails and maybe even shutting down my account. So I have to make sure I have that cash in there as long as I've got that naked put sold. But I did make 20 cents. So in effect, it's kind of like I'm out $10.80 right now. So if I go through the scenarios, if stocks close above $11, if the Ford stock closes on that June 16th expiration date, basically that put option that I sold will expire worthless. I don't end up with any stock shares. I keep the 20 cents per put option sold. So I basically walk away with 20 cents per put option sold. And if the stock closes below $11, well, then that option that I had gets exercised. That $11 that the broker made me set aside gets paid to the person, and I get the stock share. I still get to keep that 20 cents. So basically, I walk away with a stock, and the break-even price is $10.80 per every one of those option shares I sold. All right, so that's the scenario for a cash secured put. Now check out the covered call. So same thing, but I buy some Ford stock for $11.80 per stock share. That's how much it closed yesterday. And then get this, I write the Ford June 16th $11 call. So the only difference here is that instead of selling the put, I'm selling the call. And the call goes for $1.13 per option share, right? So basically, right now, if I buy something for $11.87 and then get $1.13 back, my break-even price is $10.74. Now, does that look familiar? My break-even price here is $10.80. My break-even price here is $10.74. It's basically the same, right? Whether you're doing a covered call or doing a covered put, when you do the transaction, your break-even price is basically the same. This is down about 6 cents, but usually it can be up or down about a dime, but it's basically the same. And check out the two scenarios. So if the stock closes above $11 on June 16th, in this case, my call option gets exercised. So I get the $11 per option share sold for the stock shares. In other words, they give me $11. I keep the $1.13. And so I wind up, because I spent $11.87, they give me $11. So I'm out 87 cents, up $1.13. I walk away with 26 cents per option share sold. So the outcome is the same, whether I sold the covered call or I sold the naked put. It's the same exact outcome if the stock closes above 97 cents. What about if the stock closes below $11? In this case, the call option expires worthless. I keep those stock shares. I keep the $1.13 and I walk away with a stock share that has a break-even price of $10.74. In other words, these two strategies are exactly the same. They're exactly the same. And so when I say, hey, listen, when you're talking about selling cash secured puts, that's the same exact thing as writing a covered call. It's because in us kind of nerd option academic speak, we call these synthetic equivalencies. It's the same thing. You're out the same amount of money. It's just done differently, but you're out the same amount of money. And in the two different scenarios, the same thing happens. They're synthetically equivalent. And so the scoop is there's a drawback to the naked cash secured put that you don't have with the covered call. The drawback is that when you sell that naked put, you immediately, the broker takes care of this $11 margin requirement on your account. Whereas when you do the covered call and you're buying a stock and then selling the call option, you can do those at two different times. They're not done at exactly the same time. They can be done at the same time. That's called a buy right. But here at Trading Trainer, we love to leg into these sideways choppy charts, right? And so we can do these at two different times. In other words, we can get a better price for the Ford stock by waiting for it to be at the low of a channel. And then we can get more than this $1.13 by waiting for this option to get to the top of the channel. And by spacing out when these two transactions are doing, we basically bump up our rewards and reduce our risk to almost nothing. You can't do that with a cash secured naked put because when you do that one transaction at exactly the same time, the bank puts the margin requirement on your account. So that's why we like doing the covered call strategy and legging in. And when you do a naked put, you can't leg in. So I would say that when it comes to selling premium, doing naked puts is really the same thing as doing a buy right covered call, and you have to understand that. And then number two, because you're not legging in, you're getting kind of the worst case scenario. I would use, and we've talked about this on the show all the time, I would use this naked cash secured put in a different way. I would use that when I'm trying to add a stock to my portfolio for the long term. It's a stock that I really, really love, and I want to get it at a certain price. And instead of doing a limit buy order, I'll sell a cash secured or naked put. And if I can't get it at the price I want, instead of going away empty handed, I get to walk away with some premium. So that's how I would use this strategy. But it's really not all that when it comes to those folks that are like hecklers right now and thinking that they know a lot more than the gurus out there.
Well, I mean, you've got a pretty detailed explanation there. So, if, we'll make a clip of this in case the question comes up. You can get the play-by-play. The one question that I have on this breakdown is, does the stock price have anything to do with why maybe one might be, look more appealing than the other in terms of the approach?
So you're talking about like this 6 cent difference between, because on this particular example with Ford, it looks like if I was to do the buy right on the Ford example, it would be better than doing the naked put. And there's a whole options trading discipline on comparing synthetically equivalent strategies. So the beauty of options is there's never one way to do something. If you're looking to get something accomplished, there's synthetic equivalencies of the option strategy, and you can quickly evaluate, especially if you have the right trading tools, which of those particular ways to do something is going to give you this like little arbitrage benefit, like you can see here. And so you would compare those 3 or 4 strategies and you'd say, I'm going to do the buy right covered call because I can get an additional 6 cents. That would pay for your commissions plus some. I mean, that would be the difference between some gains or not. And as far as why, I mean, there's a whole bunch of all sorts of like little variables, like the risk-free interest rate plays in, and it's just, buying and selling hype on the option that might make it a different price at the moment. But I'm telling you, when it comes to the slower type strategies like we do for setting up income, being able to leg into a transaction is really the way that we can build up reward and minimize risk, build up profit and minimize loss. And so whenever we can figure out a strategy that we can leg into, that's the one we're going to do.